What if I told you that right now might be a great opportunity to lock in a lower mortgage rate before they start climbing again? If you're thinking about refinancing or switching your mortgage, you don't want to miss this window. Hello, I'm Sujit. Today I'm breaking down exactly how the Bank of Canada's recent rate cuts can put more money in your pocket. Let's dive in. Over the past several months, Bank of Canada has been on a rate cutting journey to stimulate the economy. Starting in the June of 2024, when the policy rate was at 4.5% to today, and it decreased to 3%. That's a total reduction of 175 basis points in just over half a year. So what does this mean for you? Lower policy rates often lead to decreased borrowing rates, an opportune time to consider refinancing or switching your mortgage. Refinance lets you replace your existing mortgage with a new one with a lower rate, reducing your monthly. It also enables you to access your home equity and withdraw cash if needed. Switching, on the other hand, involves transferring your mortgage to a new lender with more favorable terms or rate. The commercial lender's prime lending rate closely follows the Bank of Canada's policy rate. If BoC cuts its rate by 50 basis points, lenders will often follow suit. Let's examine two case studies to illustrate this impact. For simplicity, we'll assume the lender's prime rate matches the BoC's rate as our focus is on the delta. Let's consider a hypothetical borrower, Mr. X, with a strong credit rating. In January of 2024, he takes out a $500,000 mortgage for his home, making a down payment of more than 20%. With a prime interest rate at 4.75% and a 25-year amortization, his monthly mortgage payment amounted to approximately $2,837. Fast forward to February 25, Mr. X requires additional funds for a life. He consults his mortgage agent and decides to refinance his property for $550,000. By this time, he has paid down approximately $11,000 of the principal, allowing him to access $60,000 in cash. Keeping the amortization period at 25 years, Mr. X's new monthly mortgage payment works out to be $2,600 at a reduced prime rate of 3%. This results in a monthly savings of merely $230, despite refinancing to an amount 10% higher than his original mortgage. By leveraging his home equity, Mr. X can use the funds for his immediate needs or invest in another opportunity. Let's examine another example to illustrate the impact of Bank of Canada's policy rate decision over the past year. As before, we will use the same analogy between the central bank's policy rate and the lender's prime rate. This time, however, we'll demonstrate the effect through a mortgage switch. Mortgage switch refers to the process of transferring existing mortgage to a different lender, usually at the end of the mortgage term. This can be done to get favorable rates and conditions. In this example, we will show the difference in monthly payments if a switch was made in January of 2024 versus one in Feb of 25. We will consider the same amortization and term. In 2024, at the end of the 5-year term of the mortgage, let's assume the remaining mortgage balance is $500,000. With a prime rate of 4.75%, in Jan of 24, the monthly payment comes out as approximately $3,218. If we take the same mortgage balance and make the switch in Feb of 25, when the prime rate is at 3%, we would have a monthly payment of $2,768, saving a homeowner approximately $450 a month. These examples demonstrate the potential for significant savings. However, it's crucial to factor in penalties, fees, and terms of your existing mortgage before you make a decision. I'm here to guide you through the process, ensuring you make well-informed decisions aligned with your financial goals.